OECD's downright gloomy forecast for the global economy, coupled with the compounding threat of a Brexit, does not bode well for emerging markets. India, however, is expected to escape even the worst-case scenario with just minor scratches and bruises. CNBC TV 18's Arvind Sukumar and Kritika Saxena find out why.
Britain will take a call on whether it should stick with the European Union or walk away later this month. And the uncertainty over that decision has already cost the economy of UK a pretty penny. Now, the OECD is warning that a Brexit could pull the UK's GDP down by 3% by 2020 has given some watchers hope that Britain's rocky marriage with the EU will not fall apart completely. As British Prime Minister David Cameron tweeted soon after the OECD's warning, OECD is right to warn leaving Europe would have negative consequences for our economy. That means lost jobs and higher prices. #StrongerIn. But it's not just the UK or the Eurozone that's been worried for a while now. The spillover of a Brexit does not bode well for any economy, especially in the emerging markets. But India, which has managed to weather most economic storms in recent months, may walk away with minor bruising. After all, the latest data pegs growth at a solid 7.9% in the fourth quarter, the fastest pace in the last 5 quarters. This has taken full-year growth to 7.6%, just above the government's target of 7.5%, and the government expects this trend to continue.
Our increased infrastructure spending, our rural spending, will enlarge economic activity. And what is most important is that in case we are able to have a good monsoon, which all indications are likely, a good monsoon this year will actually mean an increase in agricultural production. It will also mean increased purchasing power and more rural demand. So if a combination of urban and rural demand both increase, I think India's ability to improve on the 7.6%, I feel optimistic on that.
The OECD seems to agree. Its own projections show India growing faster in 2017 than in 2016 at comfortably above 7%, outstripping China in both years. China's growth rate, meanwhile, is expected to slip to 6.5% this year and further to 6.2% in 2017. This means India will remain the fastest growing economy among the emerging markets.
India's risen to number 3 out of 27 countries that we assess on a monthly basis. So if I was to summarize the reasons why, it's really that we see a GDP growth acceleration that's unfolding now, and we see an earnings growth acceleration. So India has kind of de-risked itself from the rest of emerging markets. And I think if you were to sort of summarize why, it's probably around the much improved current account balance and fiscal balance situation. So India is no longer as vulnerable to global risk-off environment when the Fed may be raising interest rates.
However, this does not mean India will be completely insulated from a possible Brexit. And unless the government delivers on its promise of reforms, especially long-pending ones like goods and services tax, the short-term pain from global factors may not be short-lived. In Mumbai, Kritika Saxena.